Right. Good evening. Am I audible?
Yes, sir.
Okay. Uh, there is a problem with my camera. I was trying to get in, but it doesn't come out. Yeah. Anyway, I have a problem with the camera, but let me continue with the voice. Anyway, you can hear. I'll share the screen. I hope you can see the screen, right?
Yes, we can, sir. Before you start, like we heard that you got with an accident. How was it, sir? Are you okay?
Yes. Thank you. Yes, last week it was the Wednesday itself. I think I met with an accident. The vehicle got damaged, but no major injuries for me. I just got my head hit the windscreen, and I was supposed to rest a bit, and I was under observation. That's why I didn't want to have the class. Now I think that was sorted. I'm good. Thank you very much.
Okay, sir. Great. Thanks.
So yeah, unfortunately, my video is not working because I have changed the laptop. We'll continue with the sprint, right? Right. So I think we completed the operational risk. Now we are getting into a new topic. That is credit risk. Right. So you have 15% weightage. A 15% weightage for this. So I think when you look at the financial sector, especially banking sector, one of the basic risk categories that we discussed is this. That is the credit risk. Because when you deal with credit, the loan book, this is an unavoidable risk that you have. So when you look at this, you can see the definition. Credit risk is the risk of loss caused by the failure of a counterparty or issuer to meet its obligation. So what does it mean? It has two parts, right? So it talks about failure of a counterparty or issuer, right? Counterparty or issuer. There are two parties. Now we'll discuss each of them. As you can see, it exists in two broader forms. When banks lend money, the primary objective of the banks when they lend money, and that's what they are looking at, right? That's what they're looking at. The party, whoever is taking the money, should be able to repay the capital as well as the interest. So if there is an inability to recover that, then that's credit risk. That's the basic version of it, right? Right. Then when you say counterparty, the party on the other side, right? The party on the other side to a transaction. Either the buyer or the seller, because when you are selling, the buyer is the counterparty. When you are buying, seller is the counterparty. The risk that a counterparty fails to fulfill its contractual obligations, because when you have a loan, there is a obligation, but there's a contract that you sign. There's an obligation. And then if you look at from a bank's perspective, right? In a banking setup, the risk that the customer fails to pay a bank loan, that's the primary thing you get. Right? That's the primary method. And then the risk that a company with whom the bank does business declares bankruptcy before having paid for goods or services supplied by the bank. That is not just the lending or loan, then there can be other situations where the bank deals with this party and the other party. Before they pay, they go bankrupt. So finally, you are unable to get it. Then another situation is the risk that a broker from whom the bank has purchased the bond fails to deliver or delivers late. So, when you look at, let's say, the financial instrument like the treasury bills or bonds, right? Various instruments, you might not get it from the issuer, right? Directly. So whoever the party issues it, you might get it from a broker or a third party. And then you're supposed to get your portion or your revenue from that party. And if that party is not honoring, you're again in trouble. That's the idea here. Now, when you look at counterparty and issuer, so at times the counterparty can be the issuer itself, because if the bank has taken the loan from the issuer itself, original issuer itself, then in that case, the issuer becomes the counterparty, right? But there are times the bank may not directly take the bond from the issuer. You might take through a broker. Then the broker becomes a counterparty. So therefore, it can be either issuer or the counterparty. So when the issuer, but at the end of the day, it's not the broker who pays the interest. It's not the broker who pays the interest. It is the issuer. So if the issuer is not paying, the investor won't get it. So understand the difference, huh? Then you have settlement risk and pre-settlement risk.
So that part is not clear. Can you re-explain it?
Which one? Previous one?
The previous slide, yes.
Yeah, this one. So look at this, right? When you say a counterparty, that counterparty is the party at the other end of your transaction. Right? So for example, a broker, whoever is delivering a bond issued by another party, let's say we get a finance, primary dealer, right? Primary dealer will issue the treasury bond to the bank who is investing it. Bank may not be a primary dealer. In that case, the bank's dealing is with the primary dealer. That primary dealer is the counterparty. Right? Now, the primary dealer, you invest in the primary dealer. And the primary dealer is supposed to deliver you the treasury bond, which is issued by the government. If the primary dealer doesn't issue the treasury bond from the government, then the primary dealer fails in its duty and you lose as a bank, as the investor. But the primary dealer is not the issuer of the bond, right? Primary dealer is taking from the government and issuing it, delivering it to you as a counterparty to your contract. Just the counterparty part. If you directly invest in the treasury bond, maybe some banks are also primary dealers, because without a prime, you have to be a primary dealer to deal with the central bank to get the treasury bond. Some banks are not primary dealers, but if you are a bank with the primary dealer facility, you can directly deal with the government and take the bond. So in that case, the counterparty becomes the issuer itself, that's the government. Right? So you understand the roles, right? Counterparty is the middle party. Counterparty is the party at the other end of the transaction. That counterparty can be a middle person or a broker, or counterparty can be the issuer itself, depending on how you deal with it, right? Now, then you look at the issuer part, right? So in the previous case, there is a good quality party, whoever is issuing the bond, that's the government. But the bond is good. They are honoring the interest payments, right? And the problem is with the broker. The broker is not delivering the bond on time or as promised to the investor. So, right, therefore, although you have invested in a bond that is issued by a quality issuer, because of the broker's problem, you are having a credit issue. The second scenario is that the issuer, right, so the broker is delivering, broker in the middle is delivering the bond to the issuer. But in this case, although the broker delivers the bond, the issuer defaults. The issuer doesn't pay interest on time, or issuer goes bankrupt. So in that case, the investor is affected because the issuer is not doing their part. So there are three parties, right? The issuer, the broker, and the investor. So those three parties won't come in all cases, right? In this case, you can have issuer, broker, and investor. So in the first case, the investor is the issuer is good, but the broker is bad, then you are suffering. The second case, broker is good, but the issuer is bad, then you are suffering. That's the scenario they are trying to explain here. When you have three parties involved, right? Sometimes when you have two parties, you directly deal with the issuer without the broker sometimes. In that case, both the issuer and the counterparty are the same. In this scenario, what is given, issuer and the counterparty are not the same. Two different parties. That's what we need to understand. What's the meaning of issuer and what's the meaning of counterparty? Issuer is whoever is originating the instrument. Counterparty is whoever is delivering the instrument, right? So both origination and issuing can happen at the same party. In that case, they are playing dual. I hope I made it very clear now, right? You understand what it means. Any further clarification you require?
That's fine, sir. Thank you.
Okay, great. Right. Let's go to the next one. Settlement risk and pre-settlement risk. Now, when you say settlement, when you have a contract with another party, that party has to settle it. Right? Then when you have when you have a transaction, there's one party is delivering the instrument, other party is paying, right? Then that is a settlement. But when one party delivers, other party is not paying, then you have a risk. Right? That's what it is. The next one is pre-settlement risk. Pre-settlement, the risk that an institution defaults before settlement of the transaction, where the traded instrument has a positive economic value to the other party. Right? So, I mean, sometimes there can be situations where before the settlement, there's a time lag, right? You have times, and there is time to deliver or time to settle it. But before that settlement point happens, the other party is defaulting. In that case, the idea here is that when you have trade, let's say it says the positive economic value to the other party, that means when you invest in shares, let's say, for example, right? So there is a value for the other party, although that value might not come directly through the instrument itself. It can flow to the organization, right? Because there is a market sentiment, market value attached to it. Right? That's what it is. We will understand more when we discuss examples later. Right? Right. Systemic risk. I think we have touched this some time ago as well. When you say systemic risk, it's not systematic risk. There's another one called systematic risk. Right? We'll discuss that. So there's systematic risk, unsystematic risk, right? And there's something called systemic risk. Systemic risk is when the entire financial system breaks down, right? Rather than an individual organization. Let's say in the banking system, what happens is there's a situation where when one organization fails, the entire chain can fail, right? That's a situation because these institutions are interconnected, and as a result, you can have a situation where the entire system might fail, collapse, and that's what the regulators concern as well, because the regulator will look at the entire system as a whole, not as one individual bank. Therefore, they also see the connectivity among the banks and the possibility of the system failure due to a failure of one bank. That's the idea. Now, in this case, there are these. It gives some situations, right? The systemic risk exists because of the close interlink between the different parts of the financial system, because these institutions are interconnected, right? They are interconnected. When they are interconnected, the failure of one will affect the balance sheet of the other, right? That is affecting the balance sheet of the other. And some cash flows, the transactions. And that's the idea. So these interlinks can create major issues, that's what it says, major crises from a minor event. It can be a minor event that can lead to a major crisis because of the interlink. If you can remember, right? If you can remember the global financial crisis, that is a good example, classic example to showcase how this interlinks affects the financial system, and it goes even beyond the financial system for other industries as well, because the financial system is interlinked with other industries as well. Right. So that's called systemic risk. And then we have another matter, the boundary issues, right? Credit risk boundary issues. So the idea here is that when you look at credit risk, sometimes we simply go by what we discussed earlier, right? That is the counterparty and the issuer, right? We can look at those two, but if you look at the nitty-gritties of it, as we discussed at the beginning also, you can remember, it is not only the credit risk that we see in a financial institution. There are various other types of risk we have. We have already discussed operational risk, right? So there is a major category. So likewise, you have credit risk as well. So when you talk about credit risk, sometimes you have situations where it is not very clear, right? It is not sometimes crystal clear, and there can be ambiguities to figure out whether it is a credit risk or another risk category. For example, whether it's a credit risk or operational risk, right? So sometimes the credit risk could be a result of operational risk, right? So then we need to demarcate clearly where the risk is, right? Where the risk is. So this is a tricky thing, because if you do not classify the risk appropriately, you might treat it in the wrong way. You might even classify and analyze it in the wrong way. So if you classify credit risk as operational risk or vice versa, right? Let's say you classify operational risk as credit risk, you're exaggerating the credit risk, because that is not credit risk. Because when you treat the risk, you need to treat the operational risk by identifying the root cause, not the credit risk. That is why it is important to understand these boundaries very clearly, right? So for example, you can see, right? So the internal processes. So the efficiency and effectiveness of the credit administration operation. Was credit has a process, right? There is an administration process within credit altogether. Then in that process, you can see there are areas, administrative areas, right? Administrative processes, management policy, monetary documentation, right? And controls, contractual requirements, that is writing contracts, right? Issuing those contracts, documentations, and then the legal, so collateral management, all that is are there. So these are all operational areas, right? These are all operational areas. And there could be process issues. You know, when you define the operational risk, we identified all of them, right? Operational risk. Operational risk consists of 4 things, right? People, processes, systems, and external event we discussed. So this is a process related risk. So if there is an operational risk due to process issues, that is not necessarily credit risk, but that is within the credit system, right? That is within the credit system, but not credit risk. Next, you can see systems, the accuracy and timelines of credit risk information product to management information systems. So when you have systems, right? And then the accuracy of those systems operations, that again can lead to defaults or mismanagement of your credits, right? That can result in a loss. But if you look at the root cause come from the operational risk. People, right? Let's say there can be bad loans granted, right? Improper pre-sanction review. There is a proper due diligence that needs to happen. There is an approval process for credit. So if you don't have adequate segregation of duties, there could be certain individuals who might override the controls. One person is reviewing, the same person is approving. So lack of segregation, you are allowing the people to play, and that can result in a bad debt. So that is not credit risk, right? That is an operational risk element that has got materialized. So therefore, these are somewhat challenging in the real world. I just gave you some examples. We need to have that understanding very clearly when you do deal with this risk, right? Identify the definition, right? Identify the definition, and then clearly identify how you match the situation to the identified case of the definition. That's very important, right? Then only you can read it well. I hope you understand what I mean. So don't just say any issue resulting in loss, right? Or irrecoverability of debt is not necessarily credit risk, not necessarily a result of credit risk, right? In other words, the inability to recover cannot be classified as credit risk by default. Then when we talk about credit risk measurement, right? How you measure. There are certain techniques, right? Measuring credit risk. credit exposure credit risk premium and credit rating. Right, credit exposure. So what is the credit exposure in this case? Right. That's the amount that can potentially be lost if a debtor defaults in its obligation. Now, what do you mean by potentially lost? That is, let's say, for example, you have granted a facility to a party in the event of a credit risk materialization. There can be a risk element that can get materialized. Right? Right? Now, for example, you grant a 100 million loan. That 100 million loan is the loss, right? The complete loss you might incur in the event of a exposure, in the event of materialization. So how far you are exposed, it doesn't mean that you are getting it, right? It is the opening, the possibility, right? Then you have two types there when you take exposure, the current exposure and potential future exposure. Current exposure and the potential future exposure. So the current exposure is very easy. That is based on whatever the amount you have granted, right? Based on whatever the amount you have granted. How much is your possible exposure? The amounts are very clear. When you say potential exposure, that you don't know what the potential exposure is because you're talking about the future. So that we will have to use some techniques, statistical techniques, models to forecast what could be the future exposure of this. Those things will be discussed in detail later as we move. Right, then we have credit risk premium. I think some of you may have discussed or learned this. The credit risk premium is the difference between the risk-free, right? Default risk-free security and a security with some risk. So we generally consider what is coming from the government is risk-free, which is now questionable as well in the current context, though, right? But that is considered as risk-free because there is no question of defaulting, right? That's what we consider as risk-free. Then you compare another instrument which has a risk, and then anything above the interest component that you pay above the default risk-free instrument. The treasury bill rate is 7%, and you have another instrument which pays 8%, or a private bond which pays 10%. So that differential is to compensate the risk, right? So then, in order to compensate the default risk, you add a premium. That's what it says. Right. This is an example. The next one, credit rating. We discussed two things, right? This exposure, premium, and rating. Credit rating is where you assign a particular label, right? You're giving a particular tag to organizations based on their risk profile, right? So this rating is not just one element, right? It's not just the loan book or anything. These ratings are what is issued by these international or the rating agencies. These ratings are what we call composite ratings. What do you mean by composite ratings? So these composite figures, they are derived by looking at many factors. It's not just a formula with few things. It's not just like when you calculate the let's say interest rate, you calculate the cost of funds and the risk, right? Then you come with an interest rate. So credit rating is not like that. Credit rating, they consider a lot of factors, both quantitative and qualitative, right? It includes your balance sheet, your risk profile, the organizational profile, the markets, right? And the management strategy. There are a lot of things they consider. So considering everything, that's why even if the organizations are doing well, let's say if there's no issue with the organization from last year to current year, for example, however, the country situation has come, right? It has become worse from it worse, let's say due to political reasons or various other things. So because of that environmental issues, your rating can come down because that is part and parcel of this composite rate, right? So this rating is an indication about the overall organization in terms of their ability to repay what they borrow. Now you can see three major rating agencies, how they are categorizing the rating, right, into different classes. Now you can also see they have their own rating, right? They have their own rating classification as well. Now you can see the letters, right? Different letters. They are using different brands. They are using. Therefore, when you look at a rating, you must also understand who is issuing that rating, right? Because based on who issues, the interpretation changes, right? Based on who issues, it depends. Now you can see Fitch and SAP, there is a similarity between their rating, right? Whatever the rating they use, more or less similar, except in the lower grades. But Moody's rating is slightly different. They use simple and capital, right? You can see. So therefore, for an organization with the same credit or claim profile, you can get different rating from Fitch and S&P or whatever the other parties, right? So, and there's also another thing you can see here, right? That is that they broadly categorize these rating into two areas. Investment grade, speculative grade. You can see investment grade. That means if you are looking at investing in bonds, you need to look at this. And if you like speculative grade, that means those are risky investment. Risk is high. Those are not meant for rational investors who evaluate the investments using fundamental analysis and do logical professional investment. Those people generally don't deal with them, but the gamblers can get in there. That means because higher the risk, higher the return. So as you know, there's a link between credit risk premium and the rating, right? Because the rating explains the risk. Higher the rating, lower the risk, right? If you have a higher rating, that indicates a lower risk for the organization. When there is lower risk, the organizations have the ability to offer lower interest rate as well. They can say we are a low risk company, so we will pay a low interest for the bonds that we issue. That's the advantage of rating, right? When you get a stronger rating, you can source funds at a lower cost. But if your rating is low, that indicates a higher risk. And as a result, you are supposed to offer higher return to the investor as well. That's what you need to understand. Any question? Right, no questions. Let's move. Now, the Basel Code introduced rating-based methods to the calculation of credit risk. So that is a logical way. When you say rating, so they don't just mean the organizational rating alone, because rating can happen at different levels, right? If you look at Fitch or these rating agencies, they provide rating at 3 levels. They provide rating at instrument level. Instrument. Say, for example, when you talk about issuing a debenture, right? When you talk about issuing a debenture, you can get a rating from these rating agencies, right? That is applicable only for that debenture, that instrument. That's an instrument level you are taking the rating. Then you talk about entity level rating, right? Entity level rating. You can have a rating at the organizational level. Then company or the bank might get a rating. So then they issue that rating. What is the rating for this organization? Then the next level of rating is country level, right? Country level. So these organizations issue rating for the country as well. Sri Lanka, what is the rating? That country level rating affects the organizational level rating as well. You must have experienced. We have some organization like Bank of Ceylon, NSP type of places, state-owned banks. They used to have the highest level of rating because primarily they're state banks, the default risk is almost zero. And there are other factors you consider. And with all that, they used to get the highest level rating. But at times their rating was downgraded, right, by those agencies. They downgraded the rating not necessarily because the organization has deteriorated. Sometimes they downgrade the rating because the country rating has come down. So you can't have a rating over and above the country rating. You can't say bad country, good bank. It doesn't make sense because bad country means there is the risk, right? And that risk will have an impact on the organization. So although the organization's dynamics and characteristics are much better, they are not given a better rating if the country rating doesn't support. Therefore, they are interconnected. So the Basel Accord says you need to assess the credit. And even if you look at the portfolios, you're supposed to rate the portfolio and identify the portfolio into different buckets and then assess the risk. Right? And then when you look at rating agencies for organizations, the Basel Committee has given some guidelines how to assess a good rating agency and how these organizations, right? So the regulator can recommend, right, based on those patterns. So in the UK, they are talking about Fitch ratings, Moody's, Standard & Poor or S&P, and there's another one called DBRS, Dominion Bond Rating Services. Right? Okay. Merits and limitations of credit rating. So we talked about the credit ratings, but at the same time, you have merits and limitations as well. Right, let's discuss. Right. Credit ratings are a useful method for lenders to assess the credit worthiness of a borrower. Those are merits. Right? Those are merits. Criticisms. There are criticisms. Companies have not been downgraded fast enough. Now, this is an allegation, I must say. This is an allegation against rating agencies. Right? they say the agencies don't have the appetite to downgrade the organization as much as they want to upgrade. So for one reason, they are also doing a business, right? They are also doing a business. And they depend on this organization. And one of the classic cases, some of you can remember, this happened way back in 2000s, right? The Enron case. So the classic case, what happens at the Enron case, Enron was getting a lot of traction in the market and they kept on winning even awards for good governance and all kinds of things, but the organization went bankrupt. And even the auditor who audited the organization was also under threat. They also lost their reputation and they were subjected to regulatory fines. So what they said was the rating agency did not downgrade the organization. As a result, they didn't, or the market didn't get the right signal. Even the global financial crisis, if you can recall in 2008, right? 2008, when you talk about global financial crisis, there was an allegation to rating agencies for overrating the financial institutions, right? For overrating the financial institutions. As a result, the investors and others got the wrong signal. And then they artificially inflated the value of those organizations. Right? That's a criticism. The next one is having too familiar relationship with company management, possibly offering themselves to undue influence. And this is there even for auditors, right? When you keep on doing your job for several years over and over, you tend to build a rapport with the organization, relationship, right? You become buddies sometimes. Then what happens when the auditor, the regulator, whoever the party supposed to do an independent job becomes too much familiar with the staff or the management, they tend to soft pedal their job, right? They sometimes, when there is risk, they will downplay. They sometimes ignore it, or maybe they have a compromise and we have some kind of an understanding. Okay, let's park it somewhere we can accept, or what where we can justify with our logic or whatever, right? So then you tend to soft pedal it. So that is a problem. So familiarity is one. That's why even in the case of auditors, there are rules. They need to rotate, right? Partner rotation, auditor rotation, those things come in because then otherwise you are allowing the familiarity threat. Then there's an allegation for making errors in rating. Because as I told you, rating, when you do a rating for an organization, that's a complex thing. Because you are trying to assess the organization from many fronts, both quantitative and qualitative. And in the end, you are trying to sum it up in one figure, right? You just say triple A, double A's, one label, right? You just give that few letters to indicate the overall credit worthiness of the organization. So when that kind of complex calculation is done, there is always a possibility for errors, right? There are instances where some rating agencies have been challenged for what they have issued, right? Sometimes it could be a mathematical error, right? Oversight, some formula. Those are criticisms. Right. Any questions? Right. Let's go. Now I am coming to another interesting thing now. This is somewhat familiar to those who are in the credit area, right? Credit risk area, impairment calculations. So the credit risk in a formula, you have three things. Right? Three things. PD, EAD, LGD. Right? Probability of default, exposure at default, and loss given default. So the multiplication or the product of all these three will give you the expected loss. So we'll discuss this with an example. If Bank X lent ABC company 500 million and ABC then defaulted, how much is the loss? How much is the loss? What is your answer? You can give your answers. You can even type. You can talk. What's your answer? You can type. You can talk.
Less than 500 million if LGD is something.
If the come again.
It has not provided the LGD. No? That's we can't say it's similar to 500 million. If LGD is something, it's less than 100 million.
No, you based on what is given you, what you say. You want more information, that's what you're saying.
According to that information, we can't say because LGD means linked with the collateral. It has not provided any collateral. That means default amount is 500. If any collateral value is there, it's LGD gets
Yeah, you're right. Okay.
less than 500 million.
So in this case, they are not talking about any collateral. So you assume no collateral in this case. If there's no collateral, I can see some text. B depends on the collateral. Yeah, okay. Yeah, if the collateral is zero, that's what I'm asking. If the collateral is zero, is it 500 or something else?
Then LGD is become something less than 500 million, then it can come less than answer C. But that given information is LGD is 500 million. That means similar to 500 million.
Yeah. Okay. So this situation can change if there's a collateral, right? Because what is changing with the collateral? Is it LGD, EAD, or PD?
LGD.
Is it LGD?
Yes.
What happens?
EAD,
It's 1 minus recovery rate.
No.
E-
When you have a collateral, you are reducing your exposure. Exposure at default is what is the maximum loss? What is the maximum loss, right? Maximum loss is unsecured portion of your loan, right? If you grant an amount here, the 500, if there is no collateral, your exposure at default is 500. The entire thing is your exposure, right? That into PD and LGD is your loss. But if you have a collateral, you are reducing that exposure. EAD is reduced. The exposure at default now becomes 300. Whatever the loss, the maximum loss is 300 because you have 200 coverage with collateral. Right? The probability of default can be the same. LGD can be the same because that's based on your historical performance. Right? So what does it say? So in this case, when you default, then you have a problem, right? So how do you calculate LGD? 60%. Probability of default. You have to do this calculation based on your historical performance. So here in this case, you can't get all these because you don't have the details. We were just calculating the loss straight away. Probability of default is you have to take some historical events, sequence of events. Let's say you had 10 instances in the past. You have granted loans to this party. And 2 instances, the party has defaulted. So 2 out of 10, that means 20% is your probability of default. That's how you calculate. So you have to take the historical performance and then get the probability. So how many chances were given, in how many cases you defaulted, and that is a probability that you calculate. Right? Now look at this situation. Now I'm giving you a different example. Read this carefully. I'll allow you to do this. Just read it carefully and let me know what is your answer. This has all the information to calculate. What's your answer? This is not a difficult one. You identify the areas.
$80.
80. Mm-hmm. Okay. Let's see. I got one answer. Any other? So first understand. So there are three things we need to get, right? We need to get exposure at default, loss given default, and probability of default. Right? Exposure at default, loss given default, probability of default. We need to understand these things, right? So let's take one by one. Right? In the given example, it says Bank XS lent 1,000 million to XYZ company last year. That's the historical thing, right? Historical thing, last year. The value of collateral was 500. They have defaulted the total amount. So what does that mean? What is the information we get there? You have given 1,000. You have defaulted 500. So that is the hint for us to calculate the LGD, loss given default. Loss given default is then how much? As a percentage, it is 50%. So LGD is 50%. Then it was noted that this customer has defaulted 8 times out of 20 instances in the past. What is that? That is the probability of default, right? So 8 upon 20 as a percentage,
40.
40%. So we calculated LGD 50%, PD 40%. Then exposure at default. What is exposure? At the time of default, we are now calculating the futuristic one, right? We are now granting a new facility. What is the possible loss? That's the expected loss we are calculating, not the historical loss, right? Not the actual loss, expected loss. Then what is the exposure in the expected situation? So we are considering to grant 600 with a collateral of 400. So how much is the exposure?
200.
200 is the exposure. So now we have all the three information. We have LGD 50%, we have PD 40%, we have exposure at default 200. So what's the calculation? 200 into 50% into 40%. How much? What's the answer? 200 into 50% into 40%.
40 million.
40. 40. It's a value, right? $40. So 40 is the answer. That is how you look at it, right? You get the historical details to ascertain those parameters, and then you apply it in the future. The exposure, we are looking at the future exposure, right? LGD and PD we take from the historical details. That is how we calculated the expected loss. This is not the actual loss, this is the expected loss, future, for which we need to provide based on the guidelines by the central bank. Right. Any questions, clarification? Are we all good with this calculation? How we calculated that? Okay. Then it's 8:30. Let's take a break and we'll get back after the break to continue. Right. Let's have a look. We did this example. Let's move. Credit events. This is another important concept we need to know. The problem with this is there is no precise definition. We can't define precisely what credit event is. As you can see, it says recognize it as a trigger point. But you can't give a whole, list, right? Comprehensive or complete list of those trigger points, because these are depending on the situations, circumstances, things can open. But what we need to understand is that what it means really is it's a kind of a flag, indication, alert you get about a possible loss, right? Where you start. The trigger point is the starting point. So here are some examples, right? You can't give a complete list, but you can give examples so that you can understand what it means. So and the task of the credit officers, right? There is a process when you talk about credit. There is a pre-sanction review. Before you granting the loan, you have a review. Then you need to follow the guidelines, protocols when granting the loan. And then there's something called post-sanction review. Post-sanction review is after granting the loan, you have to continue to monitor the loan facility until the facility is paid in full. But unfortunately, in many cases, what happens is we tend to start monitoring or following up after granting the loan only when there is a trigger, only when there are risks, only when the customers stop paying, right? That should not be the case. We have to keep our radar open and active to search these credit events or trigger points. These trigger points can come from many fronts, as you can see here, right? Bankruptcy. When the customer goes bankrupt, that means you're likely to lose the money, right? And then insolvency. The inability to settle debts, cash flow issues, failure to meet payment obligations, right? Then there is default, right? Missing the installments. Those are triggers. restructuring. When an organization is going through a restructuring process, that is probably because they're suffering from financial crisis. That's a trigger point, right? There are two things. So restructuring is a realignment of it, and then there can be growth related restructuring as well. So maybe the organizations can be realigned to their new vision, new growth path, without any issue in the company. But when you say restructuring here, we are looking at the company is trying to adjust itself to manage some difficulty or manage the crisis. That's what the idea is. This restructuring mostly involves layoffs, right? Layoffs, eliminating managerial positions, cutting corners, costs, right? Moving from high cost structures to low cost options. All these restructuring, modality will suggest you whether the company is in trouble or not. So those are indicators, trigger. Credit rating downgrade. We discussed about the credit rating. We discussed about the credit rating. Now, when there's downgrading, that means the risk profile of the organization is going up. Then currency inconvertibility, right? Currency inconvertibility. So that happens especially when you are dealing with foreign currency. So we sometimes face this situation. There are organizations dealing with foreign countries, and some countries have this currency convertibility issue because some are not hard currencies. Not every country has hard currencies. So I have an example some time ago. I think even today they may be having similar issues. There was a situation in Maldives, right? That's more or less there anyway, right? They have a lot of foreign currency being circulated off the system, right? In the black market, informal market, you have a lot of dollars, but you lack foreign currency in the formal market, right? Then they say we are able to settle your dues in rupiah or their own currency, but they don't have dollars. There's a convertibility issue there. So that can cause problems for the banks here, whoever has lent them, because when there's inconvertibility, you can't convert the money into the money that you deal with and circulate. And then that affects your cash flows and the rest of it. Right? So those situations, when they arise, can trigger those issues that the borrowers can face, which will in turn lead to losses. Then there's something called wrong way risk. Wrong way risk. Right? Now it's more than the definition. Right? You need to understand the meaning of it. So if you look at the note, you can say the risk that occurs when exposure to a counterparty is adversely correlated with the credit quality of that counterparty. Let's understand what this means. So this is a situation, let's say there's a company which is dependent on the parent company, right? Because the organization, the entire sale or majority of the sale goes to the parent company, and there is a heavy dependency on the parent company, right? And then you have a risk that you are depending on the parent company, or depending on one party for your sales, And if something happens to that one party and if the sale doesn't happen, that will affect the organization big way. So there's a risk. So if that sale doesn't happen, then this company can't settle the dues. So you have a credit risk there. So you ask for a collateral. When you ask for a collateral, this company goes and get a corporate guarantee from the parent company. Now the corporate guarantee from the parent company is your collateral, and that is where the problem is. Right? To mitigate the risk, you are getting the collateral from the very party you have a doubt. So that's called the wrong way risk. Right? That's a wrong way risk. That means that's not the way to manage risk. You are just your effort in collateralizing the facility is useless. Right? You are not mitigating the risk effectively, although it might sound technically as a risk mitigating strategy. Right, that's what the meaning is. Then we have non-performing assets. Now, this non-performing asset definition kept on evolving over a period. Earlier, the central bank has, or the regulator has given a definition. What are non-performing assets and how you classify now? So, in simple terms, right, without going into nitty-gritties, in simple terms, non-performing assets means there are assets you are supposed to generate income. You are supposed to make money out of it. Right? How you make money is by collecting the repayment along with the interest. Right? So when repayments are not coming on time, when settlements are not made on time, and there's default, at a point it becomes, non-performing. It doesn't bring anything. Asset is there, it doesn't perform. And then if the payments are late for a shorter period, when there's payment delays, you call it past due. And then when it is late for a longer period, then we classify as non-performing. So because this, if you remember, or if you look at this, even that's what the regulator says, the non-performing aspect is considered in terms of timing, right? It's a delay in time, right? More the delay, right? The situation becomes worse. Sorry, say. Then the credit limits. So that I think you all understand whoever is in system. So limit is you are giving a ceiling, right? When you grant loans, what's the maximum you can, right? So remember, the regulator's version of this is, in the end, you may have heard of this, what we call the single borrow limit, right? That's the limit. So what it says is you put a ceiling for the maximum amount one party or connected parties can take. Right? So total. So in even Sri Lanka, you must have heard there are certain very large organizations, multi-billion organizations who are suffering from financial distress. And some of them are in trouble now because when they run out of cash, they have to run to the banking system to borrow. But when they have exhausted the credit limit for the single borrower limit, they have a problem because they can't go to the local banking system and obtain funds because they have exceeded their limit. Then they are in trouble in that case. They have to find a different way to fulfill that. So when you take the exposure or the credit limit, right, we take the individual borrowers, the counterparties, and group of corrected counterparties. Sometimes the groups, you look at the group exposure, right? Group exposure took everyone together. Right. Then we have limitations, right? When you measure the credit risk, what are the limitations you have to face? Right? When you say limitation, these are not necessarily disadvantages as such. These are the areas you need to be mindful of, right? You need to keep in mind when dealing with this. Let's go one by one so that we understand what it is. It is not difficult. Using simplified calculations of potential exposure. Right? So that means we are oversimplifying the exposure calculation, and it might be a theoretical exercise. That's what it says. There's a limitation because you don't consider all possible considerations. Lack of recognition of the time period of credit risk. Right? Time period. So when you look at risk, you only look at the exposures and then set it. You don't look at the time. Then another problem is when you look at credit risk, you go by the numbers and provide based on the risk. Right? You just identify it and you provide. But there is something positive when you have diversification. What happens with diversification? You are mitigating the risk of one from the other. Right? So therefore, your overall impact will be lesser. However, this when you look at this credit risk, you just look at in total. So you don't consider, you discount or you ignore the diversification aspect. So because diversification itself will give you a lower credit risk because you are moving away from heavy dependency on one area, right? And you are building alternative income sources. As a result, your loss or the damage will be lesser because if the primary source is affected, you already have other sources. And then financial institutions use probabilities which are a best guesstimate of the future. Right? So that means you look probability. There are guesstimates. What's the difference between estimate and guesstimate? Can someone tell me? What's the difference? What's the difference? Guesstimate and estimate. What is your perception? I don't need a definition as such, but just give me your perception or the feeling about it. What does it mean? What do you mean by estimate? Hmm? So the guesstimate is relatively informal, right? Relatively informal judgment. You confidently sometimes tell, no, this is the figure. Say, for example, if someone asks you what's the exchange rate, what is your prediction about the dollar rate by the end of the year? You just look up the ceiling and you say, I guess it will be 400 rupees. So that's a guesstimate, right? You just feel it and then you throw, right? But you don't have science behind it sometimes. But estimate, you have a process. Estimate, you don't just talk out of the blue, right? You just do some level of analysis and calculations, evaluations to come to an estimate. That's therefore estimates are relatively more reliable and acceptable because there is a science behind estimate. But guesstimate are just, gut feeling. It can be either way. Right. That's the end of the part 1. Right. Any question? Any question, clarification on what I discussed? I'm going to start the next part as well. We have some more time. I'll share the screen. Right. This is part 2 of that topic we were discussing. Credit risk protection and mitigation. There's a list of things. I'm not sure whether I can cover all of them today, but let's move and start discussing one by one. Right. Right. Underwriting standards, guarantees, credit limits, netting agreements, collaterals, diversification, and insurance and credit derivatives. We'll discuss one by one, right? Then there are certain ones I need more clarification. I'll explain then and there. Right. Underwriting standards. So what do you mean by underwriting standards? So underwriting standards when you grant a loan, what we call is what are the things that they do? Right? The bank need to evaluate the credit worthiness of the customer. When someone comes and asks for a facility, you need to assess their credit worthiness.
So excuse me.
Yeah.
The presentation shared by the academy does not have this slide.
No, this is another set. Two
Yeah,
presentation.
this is the second part, yes, but this specific slide is not available.
No, this is the first slide I'm looking at.
Yeah, so the slide order is right, but the what is start is from the netting netting agreements,
No.
not with underwriting standards.
What I'm saying is, yeah, you're right, because we don't have explanatory note for all the items here. I'm
Okay,
just only putting the topic and explaining you, because these
I see.
are not very difficult ones, but I have put a detailed note for those areas where we need that, more detail. This is just I'm explaining it.
All right, okay,
It's the same slide. I'm going back. You see the first slide.
okay.
Okay. So what the banks need to assess the credit worthiness of the borrower. When you want to assess the credit worthiness, you look at different aspects. Right. So that's basically your evaluation, right? When you grant a loan, you have a checklist. You look at their cash flows, you look at their profile, right? So all kinds of analysis you do. So that is basically what are the rules, standards you need to follow or evaluate before you grant a loan. Then comes the guarantees, right? Guarantee. It's basically someone is giving an assurance or some kind of a documentary proof that other party will honor, or I will vouch for that person. I'll give you a guarantee that that person will do that or honor it, right? Then eventually you are taking the responsibility if there's a default, right? That's what the guarantee is, right? So that's the other part. So we look at guarantees from the borrowers. Then comes the credit limit. We discuss credit limit, right? Credit limit we discuss. You set different limitations or the ceilings for probably the product level or certain market, right? You can decide how you want to put those limits. That will curtail the risk. And then comes what we call a netting arrangement. Netting arrangement is a little, it's not complex, I would say. It's a concept that you need to understand how it operates. So I'll talk about netting arrangement separately with an example and how it operates, because I have a slide there as well, right? I'll just go over. Then you have the collateral, right? Collateral is what? That we all know what collateral is, right? That is, the lender keeps something as the backup to manage any possible default by the borrower, right? These collaterals, you have different types or categories of collateral. Right? Unilateral arrangements. Unilateral, that means one party gives collateral to the other party. There's only one party giving the collateral. Bilateral, right? You have obligations from either party, then you have some kind of a arrangement, right, to cover your exposures. Then you have netted arrangement, right? Then the netted arrangement means you have two parties, right? There can be obligations both ways. Let's say A is payable to B 100, B is payable to A 80. Right? There is a obligation for both parties. And then if you look at on a net basis, A is supposed to pay B 20. That's the gap. And then you get the party who has the gap to cover that gap with a collateral. So collateral value will be 20, not 100 or 80, because that's the exposure you have. So likewise, you can have netted arrangement. So netted collateral, right? So then that kind of, there can be various other ways you can give collaterals, but this is what generally works. Then diversification, I think we all know what diversification is, right? We discussed earlier as well, the high level. This is where you expand your product portfolio or your loan portfolio, for that matter, in a banking system into various segments, markets, products, right? When you do that, what happens? You are minimizing the overall risk. So one classic example is, right, we always take the example of ice cream and umbrella, or maybe some other things. You just don't limit yourself into one area. Even when you lend, you don't limit into one industry. You go to several industries. So what happens is, then whatever the risk that you expose in one industry will get diluted to the other. That's your recovering. So this here, the diversification is, when you look at a portfolio, we discuss this concept of diversification, but we'll get back later. So when you have a portfolio, you are spreading the risk, right? You're spreading the risk, and then overall risk will come down as a result. Right? That's the idea of diversification. Then you have insurance. Insurance, we know what it is, right? What you do with insurance and how you get insurance, and the process is aware. But that is also part, right? For credit, we take. Right. So then I have to discuss the netting arrangement and the collateralized credit default swap. So I will not take time now, because now I think we've done a long day, so we have a lot of technicalities, because I want to do this netting thing separately with a fresh mind. The reason being, if you go to the papers, you will understand that this is a popular question. This netting arrangement is a popular question in your paper. You need to understand how netting arrangement operates, right? How to get the best, and you sometimes need to know the practical way of happening it, right? Therefore, we'll discuss with some illustrative examples to understand how this mechanism works. That will help you to understand, because that's a favorite area in the exam, I told you. Okay, so then I'll touch it separately. Before I do the next topic, I'll touch this and then move. So with that, I'll conclude for the day. Is there anything that you want to clarify? Anything that is not clear? Let me know. Right, looks like all good. Then we'll stop the class with this, and I'll see you next week with the balance part of this and then the new topic. Right, good night.
Good night. Thank you, sir.
Right, sir.